Hello, today we're going to talk about why PEs don't matter, and I don't look at PEs. I think PEs are foolish. I think people that look at PEs and only PEs are kind of not getting the point. Um, and anyway, that's, I go explain it, today. Sorry about that. I don't know what's going on. But anyway, the PEs, ratio, and basically how you get the PE, basically you take the trailing earnings per share, basically the earnings, and then divide by shares outstanding. And basically that could give you the earnings per share. Then you add it up for the last 12 months. And then you divide by the stock price, and that gives you the PE. So essentially, it's very simple. And that's why I don't know why everybody, and it's one of these metrics that everybody clings to. It's like this metric that everybody looks to. Oh, stocks are expensive now because PEs are high. I mean, they really don't know what they're talking about when they say that. They say it because it's easy, and the average person can grip the head around it, but it's really just a horrible way to value stocks, because then you're taking a company that's P's, you know what I mean? Then you have low P's, and then they try to compare, like they could try to compare Apple to Amazon when they're completely different businesses, but they could try to use some metric to basically do it. And really, I mean, I've seen a lot of companies that have very low P's that are way overvalued than companies that have a high PE be undervalued. So essentially, and PE doesn't calculate growth or anything. So essentially, that's why I don't look at PEs. They're basically one-sided. They don't show the whole picture. Because really the best way to value a stock, if it's not a bank or a financial institution, is basically just doing discounted cash flows and stuff like that. Basically, where you add up all the cash flow, because Amazon is really the intrinsic value on the cash flow model is around maybe $1,600. So essentially around there, give or take. You can take a little bit. Everybody's valuations will be slightly different because you're trying to calculate growth and you kind of expand it out, then discount it back. So essentially, and that's really what you do. Financials, you basically just take the book value of the company and add that out, then discount that back. So essentially, and you could have vastly different companies. So essentially, if a company is very profitable, it's going to have a higher PE, just for because it's just going to have more cash flow. It's going to have more cash flow. So essentially that business is worth more. And so PE, essentially that's why a lot of retail stores, they have kind of low PEs, because retail is not very profitable. You know what I mean? Because you have to think, a lot of people can start anything, and there's really not a lot of pricing power in retail, because you have to sell it what the distributor can get it for. And essentially you can buy in bulk, but a lot of competitors can buy in bulk. That's why you have Walmart, you have Dollar Generals, you have all these stores buying in bulk and trying to cut prices, and really nobody really cares. I mean, do you really care what store? Normally you just go wherever's cheaper. So essentially it's all about prices in retail, and that's kind of how it works. So essentially, unless you have a premium brand or something like that that's cool, and people come in there just to buy that premium brand, which Apple's not retail, but anyway, so essentially it doesn't have no pricing power, you know what I mean? So essentially that's why retail sells for lower PEs, because it just has so much lower profit margins than everything else. Unless a business can figure out a way to increase profit margins without doing that, maybe like Costco, which Costco does an amazing job, which the PE is a little higher, which it should be, because it has better profit margins and more cash flow. So essentially that's why it just bumps the price up, because it's worth more, and the PE comes along with it. So essentially that's why a lot of companies, and PE, I've seen the companies go down to 5 PE and have negative cash flow. That means they're burning through cash and they have a horrible balance sheet. Essentially that company's probably worth more than that. It's probably worth a lot less. So essentially that's why you don't look at PEs, actually look at the fundamentals. Maybe I'll make a whole video about cash flows, and because that's really probably the most important financial statement is the cash flow statement, because that shows you where the cash is going. And then the balance sheet, of course, income statement, because income statement, there's ways to kind of, and here's the other thing with PEs. So essentially, earnings per share can be manipulative. So essentially, let's say a company A has earnings of 12, and then there's other company that has the PE of 12. But let's say their earnings, let's say they buy back shares. So essentially, if they buy back shares, the earnings stay the same for both companies, but the earnings per share goes up. So essentially, the PE will come down. I mean, so essentially, it can have the exact same earnings, but the earnings per share can go down. And they don't calculate that. They don't say that we bought back shares and that's why the PE They don't say that. They just say they bought back shares and this and that, and at the average price. Normally it says the average price, but it doesn't calculate that into the earnings per share. And this is actually the earnings per share. It's kind of complicated with that, and that's why Apple can actually report, low revenue and lower profit margins, but somehow still beats on earnings per share, the bottom line. So essentially, but how is that? Because Apple buys back a lot of shares, and they have a very good repurchasing program there where they normally buy it when it goes down. So essentially, that just kind of screenshots the stock up. So essentially, and the PE it's kind of distorted there. So essentially, the earnings per share goes up, the PE comes down. So essentially, it's worth more or less. So essentially, that's why PE, and let's say a company that's growing its earnings real fast, it doesn't calculate growth, and that company be way overvalued when really it's undervalued. So essentially, that's why I don't look at PE ratios. And the other thing is, when you discount it, and that's why I don't like when people compare now until the dot-com bubble, because stocks were a lot overvalued back in them days for the simple point of when stocks, interest rates, and bonds are like gravity on stocks. So essentially, if you have very low interest rates and very low bonds, stocks are worth more. Because let's say if you're trying to get a return on your investment, what were you going to take? You going to take a business that gets 10%, or a business that gets, or a bond that gets 2%? Obviously, everybody's going to pick the 10%, the business that's growing, has its earnings and cash flow growing around 10%. Obviously, why wouldn't you? It'd be idiotic to buy the bond, in that circumstance, and that the way it is, unless you think the economy's going to crash, and that's a topic for another day. But it's kind of dumb to buy bonds and hold on to them when you can buy a business that's growing at 10%. But let's say bonds go up to 15%, and stocks go down. Let's say it's still that same business. That business is a subpar business. That business is not worth more. So essentially, the bonds are worth more. So essentially, that's how it really kind of works. So essentially, if you have low interest rates like we do now versus back in the 90s, that's why the PE doesn't calculate that. And that's how you kind of get these prices. You add it out on the cash flow and then discount it back wherever the 10-year bond is. So essentially, if the 10-year bond is at 10, business is going to be worth a lot less if it's growing at 10. It should be selling at book value. So it's a lot less. But if it's at 2%, that business is worth more. So essentially, that's how it kind of works. And that P does not show that. It won't show you the bond rate and the relationship. So essentially, that's why a lot of people, they can look at earnings per share of the S&P and go, wow, the S&P is more overvalued than the 90s. And we're in a bubble and everything's in a bubble. But they don't understand that interest rates and bonds are so essentially, if you want to get 10%, you won't buy bonds. Back in the 90s, you could buy a business, a bond. I was getting that. It was about 8-9%. It's a big difference. Because then a business, let's say it's over the same business, same earnings and everything, in both scenarios, and let's say the stock is at 15%, or let's say a 20 PE ratio, that business is overvalued in that situation. So essentially, that's why it's always relative to stocks are always kind of relative in this relationship, where if the lower the bond rates, the better stocks go. So that's why in the video I go talk about interest rates cut and why stocks go up on interest rates. I go make that video, hopefully upload it, and leave it down in the description explaining the Fed and what they do. But basically, that's really what it is. So essentially, when they're talking about PE and they say, well, everything's overvalued. Your PE was at 20 times multiples and everything. Just think that bonds were a lot more. So essentially, then business were overvalued. So essentially, they don't really calculate that in PE ratios. It's just a simple metric. It doesn't calculate all the other things. It doesn't look at the balance sheet. So essentially, a company can have, a PE ratio of 5, but be $1 billion, $100 billion in debt going out of business next month. So essentially, well, maybe not the drastic as that, but it doesn't calculate that. So that's why I never really look at PE. I couldn't even tell you. I mean, I don't even look at it per se. I don't even look at PE ratios. I look at the fundamentals and actually the balance. I don't look at the PE ratios and all that. So essentially, there's a lot more important metrics. But a lot of people like it simple. They like a simple PE ratio, and they think they can look at it, and they want some easy way out. And well, it's just kind of stupid to look at that way. But anyway, hopefully that video would maybe open your mind if you're a PE searcher or whatever, evaluating companies and saying it's cheap. This business is cheaper versus this business. First, that's stupid. Don't do it that way. I've had businesses that have very high PEs, like Amazon, all the way up to 90. And other thing is, when they report earnings, usually if earnings keep growing, that PE will eventually come down. So essentially, hopefully this video helped. Remember, like and subscribe. This video, for more daily updates. I normally try to make videos like this, and I pick stocks and recommendations, and I review stocks I pick too, and I can give news if something boldly changes over the next couple of days or whatever. Hopefully this video helped, and thank you for watching. Thank you.